Welcoming all the viewers to this educational channel and presenting a class on the topic capital structure of a firm. This is a very important chapter in financial management. As you all are familiar with the sources of capital of a firm, there are various sources of funds and it can be raised by issuing equity share, preference share, debenture, and availing term loan from financial institution. So these sources of capital are used in designing capital structure in a appropriate way. So these components represent capital structure of a firm. Using these funds in appropriate proportion has vital significance in determining the value of the firm and reducing overall cost of capital, as well as it also helps to increase earning per share. So now we can say that it is a mix of different sources of long term finance. It consists of long term sources of funds such as equity capital, including reserve and surplus, preference share capital, debentures, and term loans, long term loans. Thus, capital structure is made up of debt and equity securities and refers to permanent financing. So, it is dealing especially with debt and equity mix in the capital structure. Though there are several theories have been propounded by different authors and giving the different views on capital structure. So some authors are saying that capital structure is not relevant for determining the market value of a firm. Some authors are saying that it is significant for determining the market value of share. We will come on the point later on when our respective theories are discussed with you in the class. So the design of capital structure is significant in financial management. The appropriate mix of debt, equity, financing in capital structure increases earning per share, that is equity shareholders are benefited, value of the firm, also saving of tax, minimization of overall or weighted average cost of capital, and maximization the value of the firm. Optimum capital structure is obtained when the market value per share is at maximum, that is equity shareholders wealth is maximum, and the average cost of capital is minimum. This is an optimum capital structure. So these are the significant points are considerable while designing the capital structure. An appropriate capital structure gives the benefits of these elements, and the firm can use these funds. In this regard, many theories have been developed for designing the capital structure, and many theories of capital structure have been developed in explaining the relationship between market value of the firm and its capital structure. So capital structure help to maximize the value of the firm. Among them, net income approach is one out of several theories being developed. Let us understand first about this theory, that is net income approach. The significance of capital structure decision, and it is also a relevant theory. Let us see that what is saying by this theory about the designing of capital structure. According to net income approach, this theory states that capital structure decision is relevant and a firm can increase its value and decrease the overall cost of capital by increasing the debt in the capital structure. This approach works on the following assumption. The risk perception of investor is not changed by the use of debt. This is one of the important assumptions. As a result, the cost of equity capital and cost of debt remain constant. The reason behind such assumption is that the increased use of debt does not increase the financial risks of the equity shareholders, and cost of debt remain constant with the increasing proportion of debt, as the financial risk of the lender is not affected. Perception of equity shareholders as well as debenture holders remain unchanged. It's constant. It is not increasing the risks of equity shareholders. Second assumption is that the cost of debt is always less than cost of equity, and there is no corporate tax. Therefore, according to net income approach, the value of the firm can be calculated using this formula: V equal S plus D. V stands for value of the firm, S market value of equity share, and D market value of debt. To understand the basic concept of net income approach, here one illustration is taken, and let us understand the basic calculation of value of firm and overall cost of capital or weighted average cost of capital of a firm with the help of this illustration. A firm has an expected annual net operating income, that is EBIT, earning before interest and tax is also, or expected annual net operating income of rupees 2 lakh. The firm has 8% debt of rupees 4 lakh. That is, it is a levered firm using the debt in its capital structure, and the annual rate of interest is paying by this firm is 8%. If its equity capitalization rate is 10%, that is the cost of equity capital is 10%, ascertain the value of equity share and value of the firm according to net income approach. So then the value of the firm we can calculate in this manner. Calculation of value of the firm: annual net operating income or EBIT rupees 2 lakh as given in the questions, less cost of debenture, that is interest on debenture, and it is given 8% of rupees 4 lakh, So it is a 32,000 amount of interest payable annually to debenture holders. And earning before tax, since this theory assume that there is no tax, so here corporate tax is written but it is a dash nil. So now the balance amount, this is 1,68,000, deducting 32,000 interest on debenture from EBIT, earning before interest and tax, or annual net operating income. Then the balance 1,68,000. This 1,68,000 is available to equity shareholders, and this theory assumes that 100% dividend payout ratio. So whole earnings are distributed to equity shareholders, and it is written here net income available to equity shareholders. Then equity shareholders are getting the 10% rate of dividend, and which is also called equity capitalization rate. If they are getting 1,68,000 total earnings and it represents 10%, then what is the market value of equity share capital? Then we can calculate it using this reverse of 100 by 10 into whole earnings 1,68,000. So then 16,80,000 is the market value of equity share capital, and the market value of debentures or debt is given 4 lakh. Then this is the value of the firm 20,80,000, the total S plus D. Here V equal value of the firm equal S plus D. This is how the value of the firm is calculated under net income approach, 20,80,000. Similarly, one more problem here. A firm has an annual net operating income of rupees 1,50,000, an equity capitalization rate of 10% and 6% debenture, and debenture amount is rupees 5 lakh. The firm decides to raise 1 lakh rupees by issue of 6% debenture and use the proceeds to redeem the equity shares. Calculate the value of the firm and also the overall or weighted average cost of capital. So now in this case, firm has 5 lakh rupees debentures already, and it has decided to raise the additional rupees 1 lakh debenture to redeem, to repay to equity shareholders, to redeem the equity shares. Then if this is the conditions, then the value of the firm can be calculated as under as well as overall cost of capital. Now here annual net operating income, earning before interest and tax 1,50,000, and interest on debenture, cost of debenture 6%, this is 6 lakh, because 5 lakh is already there and 1 lakh is further debentures amount is issued. So total it becomes 6 lakh, and 6 lakh rate of interest is given 6%, and this 6% of 6 lakh is 36,000. Then out of 1,50,000, earnings available to equity shareholder is 1,14,000, earning before tax, and corporate tax is not given in the questions, so dash nil, and the balance will remain same 1,14,000, and it is net income available to equity shareholders. And equity capitalization rate is also given 10%, market value of equity share capital 11,40,000, same procedure, 10% capitalization, so 100 by 10, into 1,14,000, so value will be 11,40,000. So this is to be understood that if 1,14,000 represent the 10% of equity shareholder cost of equity, then what is the total value? So total value can be calculated by reversing it, 100 divided by 10 multiplied by total earnings available, so then it is represent total market value of equity share, and market value of debenture is 6 lakh, so 11 it is total 17,40,000 is the market value of the firm. So according to net income approach, so the value of the firm is calculated. Now it is also given in the questions that calculate the overall cost of capital or weighted average cost of capital. So KO represent overall cost of capital, and KD is the cost of debenture, that is rate of interest. D represent the market value of debenture, debt divided by total value of the firm, plus cost of equity capital into market value of equity share divided by total value of the firm. In this manner, weighted average cost of capital or overall cost of capital is calculated. So this is the formula also for calculating weighted average cost of capital, WACC. And if in the capital structure it is given that also preference share capital, then if you have the cost of preference share capital, then you can add here KP market value of preference share capital divided by market value of firm. So we can add it this way, and after solving this, the result which you get, it is weighted average cost of capital. So here KD is given 6%, so that is 6 by 100 equal 0.06, and equity capitalization is given, that is the 10% is the equity capitalization, so 0.1 divided, and here the value is calculated. 6 lakh is the market value of debenture divided by total value of the firm, 17,40,000, and total market value of equity share is 11,40,000 divided by total value of the firm. When we solve it, then the results which you get, it is 9%, and it is calculated in this manner. Here this is, and this, all these values, common zeros are reduced, and 60 by 174 plus 0.10 into these, all four zeros are common, cancel it, so 114 divided by 174. So then when we multiplied it, this into this, this into this, so then 3.6 plus 11.4, and this 174, so then 3.6 divided by 174, you will get the result 3.6 divided by 174 equal, so 0.02 is taken here, 0.02, and similarly 11.4 divided by 174, 0.065, so then 0.07 here. this one, and you add it, so then you will get 0.09 multiplied by 100 expressing the percentage, so then it is 9%. So this is, and similar one problem is given to you for practicing, so all of you practice this. A firm has an annual net operating income of rupees 1,80,000, an equity capitalization rate of 10% and 6% debentures of rupees 5 lakh. The firm decides to redeem the debenture by rupees 1 lakh by issuing additional equity to the same extent. Calculate the value of the firm and overall cost of capital. So in this question, the debentures amount will be decreased by 1 lakh, that is 5 lakh minus 1 lakh, then 4 lakhs. On 4 lakh you calculate the interest, 4 lakh into 6, 24,000, deduct it from 1,80,000, and in the above manner, and you calculate the steps which have been followed for solving this problem. All of you practice it, write in the comment section what is the answers you are getting. Thank you viewers. So like, subscribe and share with your friends.